then it didn't do anything. There we go. Hey guys, we're here. This is the Macro Show or the Holy Macro Show. You don't want to call it the Macro Show. There's a very terrible show named that. Yeah, I'm talking shit today, I guess. So, anyways, a lot of fun stuff to talk about today. Hope everybody had a good holiday. We have this really crazy BS holiday in the United States called Thanksgiving, but it's really fun to get together with your family and friends and hang out. And I had a really good time with my family yesterday. I hope everybody else did too. But let's jump into the markets because honestly, for me, sometimes I get very annoyed on off days because it shuts it down right in the middle of the week. And I want to look at the market some days and understand what's going on. And for me, holidays kind of get in the way at points. I know that probably sounds crazy, but that's just the way I feel. Anyways, when we're looking at the market, though, we're seeing this stagflationary environment come into view. And as we see the stagflationary environment come into view, are we seeing the dollar moving down? Are we seeing, all the things that we would want to see to make this happen? Gold has really rallied, which usually is the thing that tells us that commodities will start to move. So gold made a huge move this year, one of the best performer most of the year this year. And then the next thing that started to move, natural gas has been another outperforming almost everything in the indices space. So natural gas year to date has been very good. I think up over 30 something percent. So once again, we're kind of seeing under the surface, there's a lot of inflation kind of boiling up. And it's been sticky. That's been our thesis all year long. Inflation is sticky. I don't think it's going anywhere. Sure, it could go lower. Sure, it could chop around. But I think the long-term trend for inflation is probably higher. And right now we're in a reflationary environment, and we'll probably be in that till year end. Stocks, commodities, a lot of things are starting to move higher. The commodity-based sectors, even financials. Financials are leading the way, actually. I think the KRE is the number one performer out of all the U.S. industries, also showing the most relative strength. So if we're seeing all of those kind of come to fruition, what are we going to see next? What do we think the next sector that's really going to start taking off if that's the environment that we're seeing? And I'll ask Kashop that. What do you think the next trade is? What if we're going forward, we're looking at the dollar hitting the top end of the range and possibly reversing. And I think I brought a chart of that. Yeah, so the dollar hit the top end of the range. I'm not much of an RSI divergence guy, but this is a good chart of an RSI divergence. Just showing, and it only works really if you're range bound. If you're range bound, divergences matter. However, you have to think about if that divergence gets resolved higher, that's usually a bad sign. So once again, keep watching the dollar here. If this breaks down and heads lower, I would be very bearish on the dollar, and probably very bullish on commodities, gold, silver, especially gold and silver above all of them because they're showing relative strength. And we'd probably head to that bottom of that range around 100 again. And the thing that you do when you are in a range, you bet on the range continuing until it doesn't. So getting to Kashop, what are you thinking about the dollar? What are you thinking about the range? Do you think if we break lower here on the dollar, do you think the fundamentals make sense for a lower dollar here? Actually, I'll start there. Do the fundamentals for the dollar lower? Does that make sense?
Yeah, absolutely. So I've been looking for the dollar to top out for a while, and in my mind, I think the dollar really peaked in October 2022 at the time of max fear, and after that, every up move that we've had is kind of muted. It's not exactly a breakout move where you can expect the trend has changed. It is just the dollar's been heading lower, is just had these occasional spots of strength. And that's the way I think about it. And I think about it that way because I see inflation coming back. Now, why do I see inflation coming back? Like, I mean, if you look at oil, if you look at gasoline, you look at heating oil, wheat, corn, any of those, you really don't see inflation. But let's think about what drives price inflation. I'm not talking about monetary inflation, which is the Fed printing money. I'm talking about price inflation. So what drives that? Consumption drives that. And what's happening on the consumption front? You can see that the S&P is up something like 40% on a year-on-year basis, and we have had two great back-to-back years where pretty much everyone has gotten richer. Whatever you owned, you made money. Now, in a situation like that, you have the wealth effect driving consumption. And you don't really, and because interest rates have been high, people haven't been, companies haven't been spending on capex expansion. So they haven't been bringing new capacity online to drive prices lower. So what's happened is everyone's gotten wealthier, everyone's consuming more, but because interest rates have been so high, producers aren't producing more. So that's the perfect recipe for price inflation. Now, the dollar strengthening has, I think, kept inflation a bit in check until now. So once we see the dollar reversing is when we will really see the ugly inflation come back. And at this point, I think the Fed has lost all credibility in terms of inflation. So first they said inflation is not a problem, and then they said it's transitory, and then when CPI hit 9% and they decided they have to hike rates, they hiked a little too late, and then once Silicon Valley Bank fell, they are like, no, no, we are going to bail out the banks. Let's do a bank term funding program. Let's reverse our QE. And then they've kind of tried to tighten monetary conditions again. So, in fact, they have actually succeeded in tightening monetary conditions. The Fed's balance sheet is back to its May 2020 levels. But here's the funny part, because the Fed is tightening so much, but you ask any market participant, and what do they say? Financial conditions are too loose. That everyone thinks the Fed is printing money. Now, it's not true that the Fed is printing money, but the banks are acting like it. If you look at bank credit growth, it's at an all time high. If you look at bank deposits, it's starting to recover from the Silicon Valley Bank crash. And if you look at pretty much asset prices everywhere, they're all showing signs of inflation. You look at even in commodities, you look at things like gold, you look at things like copper, you look at, for instance, orange juice, coffee, everything is showing signs of inflation. So, has the Fed really tightened? The market thinks not. The Fed thinks yes, but inflation is coming back. So, we are kind of in this very, uh, there's no way to tell how this resolves. So, market says we are starting to see stagflation. Purely looking at the money supply, it starts to look like deflation. Looking at asset prices, it doesn't even look like stagflation. It looks like the beginning stage of hyperinflation. I don't think there's ever been a period in history where the S&P has had back-to-back something like 30% years. And it's just crazy. And conditions like this definitely make people feel wealthier, drives consumption. So I think we are going to see inflation come back in a big way unless the Fed does something. And I don't think the Fed can do something because, well, they had their chance and they blew it. So I don't think they're going to do anything anymore. So that's the way I look at it.
Yeah, and I'm looking at trying to look up now about the back-to-back years because I feel like there's one in history, but I want to know where that was. That that could be in the '60s, right before stagflation started. So that's what I want to kind of look up. That's a good point because I don't think that people think of inflation like this. They go, it must be the food prices, it must be this, and really, like you and I know, it can be anything. Money can go into really weird things at certain times. Sure, the inflation that goes into food costs is very harmful and is going to be the most harmful to citizens. But if we're just looking at it and going after 2008, for example, you have the tech bubble that lasted forever. Basically, it's still here. So we had the tech bubble from 2008. We bottomed in March 2009. We've just rallied ever since. And that's where inflation kind of ended up there. There's a different outlook for the market at that time. You had quantitative easing. That money went to the banks. Banks got paid to hold deposits. As the banks are holding those deposits, money isn't going into normal people's hands. And so it's just driving into the stock market, basically. But then 2020 happens, and then we gave money to anybody with a pulse, basically, whether they were on unemployment, money straight from the government, money from PPP loans, whatever it was, everybody got money at that point. And so you have all this money coming into normal things. And then most people, everybody goes, oh, we just should give all the money to people. Well, most people didn't go, I'm going to invest this I'm going to put this away for a rainy day. Most people bought stuff with it. So they buy cars, they buy steel, they buy whatever, not saying they're buying steel, but saying they bought cars, which ends up putting pressure on steel prices. And all these things end up putting pressure on the commodity market, because at that point, normal people had money and small businesses had money, not just the banks. So now we're at this point today. What do you think the catalyst is now? Because that's something that I keep trying to wrap my head around. Are we just in that cycle because we already pumped so much money in, which is something that I do think that does matter. So there's already this much money out there. It could still keep going. Or is it something where there's going to be a new catalyst that comes into play? Maybe a catalyst that people aren't paying attention to, that should be on our radar.
So I think people's relationship with money has permanently changed. So during the pandemic, the Fed printed $3 trillion in a span of 40 days. Now, you do something like that, and that money, of course, made its way throughout the economy. In fact, it made its way throughout the world because every other central bank imitated the Fed and did the same. So in a situation like that, when people perceive money to be something that can just be printed up out of thin air, and you and I have been in crypto for a long time. We have been holding Bitcoin since 2015 for me, probably the same for you. And we know that when we first started in the space and we told people central banks just print money out of thin air, that fiat money is just money by fiat, meaning it gets its value from the government through fiat, through a fiat issuance. And people stared at us like, what are you even talking about? And now the common man knows that paper money is just, it's not even worth the paper it's printed on. In fact, when Zimbabwe printed their $100 trillion note, I think they just printed one side of it because, why bother printing the other side? So everyone just knows that paper money has lost its value. It's become common knowledge that the central bankers just print it out of thin air, that the value of these notes comes from the government. So when you have this situation where overall trust in money has gone down and inflation has skyrocketed, and then you have people like Paul Krugman telling us that, CPI excluding food, excluding healthcare, excluding automobile, excluding energy, everything has gone down. So what are you worried about? And then you have magazines like The Atlantic, I think they came out and said, inflation only matters if you earn less than $300,000. Well, yeah, that's pretty much the entire world. How many people earn more than $300,000? And when you have these statements where these elites, these economists, they all try to gaslight you into saying, no, you're wrong. There is no inflation because we said so. And then you have the BLS blatantly coming out and saying they removed coffee from the CPI, but don't worry, they publish the coffee numbers separately. So, they haven't exactly removed it. And you see all these tricks being played, trying to gaslight people into thinking there is no inflation. And then, of course, there's this big problem of shrinkflation, which I hear from Americans that your package sizes are getting smaller and many people don't notice it, some do. And you have all sorts of inflation just happening, and it's common knowledge for literally anyone. And in fact, because we have been talking so much about inflation, I've been monitoring prices at the supermarket, so the essentials like milk, eggs, and I can kind of see it going up, not in a big way, but little by little I can see that inflation coming back. Now, put all this together, people's relationship with money having changed, the central banks, printing it willy-nilly, and then everyone trying to gaslight you into thinking there's no inflation. You get a pickup in numbers like we just saw yesterday. Everyone's just going to think inflation is coming back. Now, it doesn't matter if the Fed is tight, is coming back. The expectations will ensure that that's where you have the wage price spiral. So you have the unions and so the longshoremen, they got a 68% wage hike or some crazy amount like that. Now, if inflation is 2%, why do they need 68%? Well, because they see their cost of living going up. So you have inflation everywhere. It is just not something that you see in the central bank's balance sheet. Now, there are two, three ways this could play out. One is this is just a pause in money printing, and the Fed does something crazy again. Like, I mean, if you can print $3 trillion in 40 days to fight an imaginary virus, how much can you print when you really need to save the bond market? How much can you print when you need to save a big US bank? It's an infinite amount. So they'll just print. Or they could really try to kind of deflate the asset bubble so that they can keep the game going longer. Because let's face it, if the central bank prints money now, we are going straight to hyperinflation. I don't think we are going to stop. The way everything is running, you saw two back-to-back great years for the S&P. That's probably going to be 3, 4, 5, and people's relationship with the dollar will be forever changed. And if that happens, I don't even know if the dollar can be the reserve currency of the world anymore. So you have all these things going on, which makes it they really have tried to prick this deflated just a little bit so that they can keep the game going longer, or they go straight to hyperinflation. I don't know. I think the market is pricing in the hyperinflation, stagflation scenario, and the central bankers are trying to get a little bit of managed deflation. Whichever way this plays out, we'll know now during this lull period. So I don't think until Trump takes office, the Fed is really going to do anything. So let's see how the market and the Fed battle it out over the next 2 months, and then we'll really know what's going to happen next. I think until then, we are just guessing.
No, for sure. And I brought up this chart of coffee prices, and just kind of makes you laugh. They took it out of there, and it's like you have this massive run in coffee that's been going on since last year. Um, it's gone on for over a year now. I think that started in October is when it bottomed. And we're talking about coffee prices have gone up 121%. In the United States, everybody drinks coffee. Kids drink coffee. It's crazy. Everybody drinks coffee. So once again, it matters. Like, these things matter. And as a commodities trader, I'm sitting here all day long going, okay, well, I see inflation. I don't, the CPI reports don't really mean much to me besides something to look at to see what the Fed's doing. Same with PCE. It's just to look at to see what the Fed's doing. Really, though, if you look at the general market, there's things that are moving, and they're moving in big ways. I mean, natural gas is another one that's started to move and then backed off. And it's basically like, people could look at it. I don't know why that line's where it is, but it is what it is. But basically, if we're looking at it here, what's it since, the bottom 109%, so we're looking at 109%. So if we have 109% gain in natural gas, we have over 100% gain in coffee. Cocoa is, who knows where it's at today. I think it hit another new high. I was, Sam was on with me the other day, and we were talking. He was like, yeah, I think you're going to get a new signal in cocoa. And I said, no, that's over. And then cocoa gave me a new signal 5 minutes later after we got off. Cocoa's also one where we're talking about 150%, 200%. And these are all just this year. This isn't me going back very far. This is just 2024. 2024, we're seeing these massive moves. Sure, natural gas.
Lumber. Lumber and
I don't know where it's the LBR contract now. I don't know where lumber. So if we go to the beginning of the year, we got our signal up here. So we're not as cool as buying right at the bottom. We're never, ever going to buy at the bottom. But, if you look at the beginning of the year to now, that's 20%. That's lumber. That's housing materials. Like, look at this stuff over and over again. You're seeing the same kind of pattern building again and again. And it leads to that long-term chart that we're always bringing up here, which thanks, Grant, for updating this one for me. But just looking at it, we're really, really, really in tune with this cycle. If you go back to the 70s, and I'm not saying I honestly hate analog charts. I don't think they're the best things in the world to use, but I do think it gives us a picture. And that picture isn't, the one thing that Livermore said in his books, which was always really good, which is price patterns work because human behavior doesn't change very much. And it's the same thing as this. Like the Fed, do I think the Fed doesn't have hubris anymore and doesn't and believes that they have solved inflation and that they can lower rates again, just like they did in the 70s? Yes, I do. I fully believe they just did it. They just came in and said, "Hey, we look at inflation. It's great." Like you said, Krugman's on going, "Look, we won the war on inflation. If you just take out all the things that matter," and then you get Powell basically patting himself on the back, telling everybody how great he is, how he's not ever going to leave. Like it's just spot on for this type of cycle taking off and just ripping their faces off, and it'll catch a lot of people off guard. And that's the thing that I want to talk about next is how do we take advantage of it? That's the other thing. We always have to think of that as traders, is how do we take advantage of it if we are into this inflationary environment. And you guys who followed me for a while, and I was talking about this, and I said if we're gonna get any decisive move in this, it's gonna happen after the election. So far, we've seen the election. A lot of things have held up. Energy is holding up really well. Industrials have just taken off and not looked back. Financials, which usually do well at the beginning of an inflationary environment, those are moving. So pass it to you, Kashop. How are you taking advantage of it? You mentioned before the other week about the gold miners. Have you found any names that you're picking up now? You don't have to name all the names. I know you have your own subscribers, but maybe just one name that is a kind of a blue chip one that maybe some people aren't on a lot of people's radar right now.
Sure. So this is a perfect time to buy the gold miners, and that's mainly because it's tax loss season. And what that means is everyone tries to declutter their book at the end of the year and they book all the losses that they have so that they can offset the gains. So, what that does is anything that's down for the year tends to go down a lot more for no fundamental reason. So, that's when I like to get involved. And this season is a little different because Canada hiked its capital gains taxes, so the scramble is even higher this time to take some losses. So, what am I looking at? So, I recently bought a few stocks. So, let me just one stock that I bought recently is Allied Gold, and this is started by the ex Yamana guys, Yamana Gold, and um, it's like a 1.2 Canadian, $1.2 billion Canadian market cap. They have mines in Africa. Sounds really scary, but the valuation was compelling, so I got the stock. And another stock I got recently is Resolute Mining on the ASX. Now, that's an interesting one. So the CEO of Resolute was called to Mali to discuss something with the Ministry of Finance. He goes there, gets a knock on his hotel room, cut him off to jail, and they demand a tax ransom of 160 million US dollars. So the stock just halved, and finally they cut a deal. The guy got released, he got out of the country, good for him. And I bought the stock thinking the worst must be over. So I don't know if the trade is going to work or something else is going to happen, but these are the kind of situations that I'm looking at. So something that's extremely risky, but you get kind of get paid to take the risk. And I'm looking at this company called Caledonia Mining. So that's a smaller cap, trades at less than 1x sales. Now, 1x sales sounds like a good valuation, and it is because if you look at something like Coinbase, which I just tweeted about earlier today, that stock trades at 20x sales, and it makes no sense. There was this quote from the CEO of Sun Microsystems. I don't know if you remember that during the dot-com bubble, where he said, "At 10 times sales, I basically have to stop all R&D, stop paying my employees, stop paying taxes in order to give you your money back." And now we have stocks trading at, there was a time when a 20 PE was considered rich. 20 times earnings was considered a rich PE. In fact, the S&P 500 had a PE ratio of 2022 around that. And now you have stocks trading at 20 times sales, and people just don't care. They think that's a fair valuation. And that's kind of so when we talk about inflation coming back, I think that's something that's going to be very different this time. So until now, you had these tech stocks where you have these earnings which are stable and growing and they trade at crazy valuations, and then you have these commodity stocks that trade for 0.5 times book, 1x sales or even 0.8x sales, and you have this crazy disconnect in terms of valuation where one set of companies gets accorded a crazy high PE, crazy high valuation multiple, and another set is pretty much left for dead. Now, when inflation comes back, you're going to see all these companies with real assets, they are going to get valued so much more because one, real assets are hard to find. So finding and developing a new copper mine probably takes something like 20-25 years, and that's if you're lucky. So I think those real assets are going to come back and they are going to get a higher price to sales multiple, while the tech companies, the software stocks, all of these guys, the crypto stocks, I think for all of these companies, the valuation multiple goes down. Now, the valuation multiple going down doesn't necessarily mean the stocks crash because they're growing their cash flow, they are growing their earnings. So if you're growing your earnings at 30% and you're trading at say 30-40x sales, at some point you will catch up to your valuation. It's just that the investors are going to sit on a long period of zero returns. Whereas commodity companies trading at 0.5x book, and the book value, the market value of their assets is going to be over book value because of inflation. So you're going to see a lot of these stocks catch up and become the new growth stocks. And if you remember, we kind of saw this happen in 2022 where tech took a big hit, energy stocks shot up, miners did okay, the shipping stocks shot up. So you had this situation where valuations kind of converged. And then 2023, Silicon Valley Bank got bailed out, and then tech, crypto, everything took off again. And real assets are kind of not, they're not done badly, but they're not done as well as the semiconductors or the tech or the crypto stocks. So I think that's all going to change. And that's a good part of so we have all been talking about the max 7 and the concentration risk in the S&P. So I think now is when we come into the cycle where we get a proper bull market. And in a proper bull market, you're going to see a lot of sector rotation. A terrible bull market is one where just one industry keeps going up and everything else kind of stagnates. And which is what we had in 2023. It was just the max 7. This year, the rally kind of broadened. A lot of other things took off, but not quite everything. And I think next year is when everything linked to real assets takes off and even real estate maybe makes a comeback. I don't know. But I think we're going to see a lot of sector rotation and it's going to surprise people who have kind of gotten used to tech and semiconductors outperforming.
I think so too. And just to kind of dumb down what you said earlier for people who are look at valuations and don't really understand exactly what Kashyap was saying there. Think about it like basketball players or football players. You have a scout, they go out to the college and they go, oh well, I don't, and usually they don't want the person who's been the person who's been in college for 4 years who you could put on a team and who will actually do well. They don't want to grab that person. They usually want to grab the person who's 1 year in college that they think has a ton of potential. Oh, they got the right body type. Oh, they got confidence. Oh, they look good. Things like that really matter to people. And if you really look at it, go back to the movie Moneyball. That's a great movie. So the movie Moneyball actually can kind of really clear up what that means and what I'm talking about there. But really, your people now are looking at what a stock could be, instead of what it is. And you have to understand that because one, it's the reason why technicals work, because you can make money on this, understanding that people believe these things. But you also have to understand that you have to have an exit strategy. Like if you don't have an exit strategy and people just believe something, one day they figure out what it really is. And when they figure out what it really is, things usually crash. This is normal movement in the markets. You can still make money trading it, long and short, but you just have to understand that that's how markets move, and that's why they move. That's why things go up way more than people think, and why other things go down more than people think. And looking at the assets that I have today, I'm just looking over my portfolio and I'm like, I'm long banks, industrials, energy, things that I haven't been very bullish on for a little while. These things have moved over the years a little bit, little by little, but they're really starting to take off. They're leading the way. If you look at the relative strength, they've been leaders. Now they're leaders. They were laggards. Now they're leading. Energy is coming up quickly. Natural gas is taking off. So, like you said, I agree with you on real assets. It's going to be like you have to own some real things. People out there are just not used to that at this point. They want to buy the hottest stock. They want to buy the biggest tech stock because that's crazy to me. It's really crazy if we think about our time in the market. Go back years ago. Could there ever be a situation where you saw the returns that could come from a large cap stock that have come in the last couple of years? Apple, for example, I was watching a show the other day, a documentary, and it talked about Apple's 1 trillion valuation, remember, in 2018. And that was so crazy. Apple hit 1 trillion. And it was like, man, it probably can't go much further than that. Now it's a few trillion. It's like, it's insane. So there's just so much money going into these markets at this point that money's going to come out and go into these other areas because money always goes where it's treated best. And as money's treated best in other areas, if these valuations continue to get completely out of hand, people will start taking money and putting into areas that look good. There's a reason why energy and financials are the biggest value stocks. If you look at the value ETFs, just basically held energy and financials. And the reason why is because they do have value still while everything else really doesn't. You just have to label everything else growth because everything else is just growth. And everything else that isn't growth is basically value. And that's kind of how they do that. That's why those value and growth funds are kind of ridiculous. At the same time, there's a methodology in looking at it and going, okay, well, that's the reason why that looks like that. So anyways, want to talk and go into what's next. So what are we thinking about if we're looking at inflation and we're looking at gold miners? And what would be another sector you would say people should be paying attention to?
So broadly, what I would say is you have to start looking at companies which have a ton of debt. And that's just because until the Fed started its rate hike cycle, interest rates were close to zero. And companies really got rewarded for taking debt. In fact, companies took it to such a level that they issued debt and used that cash for share buybacks, not to invest in capex, not for growth, just for share buybacks. And that was the era of QE and zero interest rates. And then what happened? The Fed hiked rates all the way up to 5.5%, and all that debt started to really pinch. The interest cost on the debt really started to pinch. And now the Fed is started to cut rates. So the interest expense is going to go down. It's going to get easier for them to refinance debt. And whatever money was earlier going towards interest is now going to come right back to shareholders. So you have this boost to earnings just from interest rates going down. And the more indebted the company is, the bigger the boost. And the more indebted the company is, it also means it's in a very cyclical industry. And cyclical industries were hurt a lot during the Fed's rate hike campaign. So they are the ones who are going to come back the most now that the Fed is cutting rates. And I think the perfect example of this is Royal Caribbean. It's in the S&P 500 and it's up something like, let me just check that. It's up 88% year to date. And that's crazy. The stock has just gone straight up. It could be Nvidia or Bitcoin, the way it's gone up. And that's just because they had so much debt, made it easier to refinance, and economy is booming. So consumers are paying higher deposits and booking their slots for their cruises. So everything looks good for their business. And there's just a factor of interest rates coming down and the economy kind of being in Goldilocks or reflation. So you look at stocks like this now. I wouldn't say buy airlines, though I'm sure you own airlines.
I
I
do.
wouldn't say buy I wouldn't say buy cruise lines, but the theme here is you pick these highly indebted companies and these cyclical sectors which have been extremely beaten down and you buy it now. You pick a good basket, you're guaranteed to make money. and that's just a function of interest rates. And it's the same with bonds. I think if you buy 1 to 3 year out bonds, you will make money, and that's regardless of inflation and whatever happens to interest rates. And that's just because people are going to be rotating out of 30-year bonds into 20-year bonds, 20-year bonds into 10-year bonds, and so on. So as people lower the duration risk on their portfolio, the short dated bonds will do better, and that's regardless of where real interest rates go. So I think these are a few obvious trades you can take. Now, where am I looking at personally? So I'm looking at shipping, because the last month, especially tanker rates, oil tanker rates, product tanker rates have come way down, and the sector looks like it is going bust. And I think that's the perfect time to shop for bargains. We haven't seen these bargains in shipping since sometime in 2020. That was when, you remember this, I wrote a report on oil tankers. So we were doing mostly gold and uranium and silver stocks until then, and then that was the perfect time to get into oil tankers, and we wrote that report. So I'm looking at getting long the tanker stocks again, and looking at getting long the dry bulk stocks again. And I also have a few LPG LNG plays. So one of those we talked about as a Trump trade, the Next Decade Corp, where they're building an LNG plant in Texas, and that stock is now up something like 45% since Trump won the election. So that was a good trade. So I'm looking at stuff like this. And of course, the miners, the gold miners, and I'm also looking at copper miners, because I think now with copper at $4, some of the speculative interest that was sending the copper stocks way too high up for me to be comfortable holding it for. So when something has good momentum, you can trade it, you can make money. But with copper, gold, with the shipping stocks, kind of tend to have like a 1 2 year time horizon where I don't really want to trade it as much as hold it for the entire duration of the top trend. So I think copper stocks are getting to a place where now I can just buy and hold it for a good bit. So those are the sectors I'm looking at. And energy, not so much, because um, I had quite a few energy positions and they all ended up getting stopped out. And I think oil really, WTI really has to hold somewhere around the 66 level. It's sort of there, but it has to hold, and it has to hold that even after the ceasefire deal is announced. So I don't know if that's going to happen. And I think probably when it happens, that's when oil will start to take off. So maybe I'll buy oil stocks then. But right now, I am very likely positioned on oil.
Nice. No, I agree with all of that, and I think that's something that we're going to continue. And the Jets ETF, man, it's I put out a thing to subscribers that I can't believe I'm saying this, but I'm buying the Jets ETF. Because it was just that ridiculous. Like, how do you, after all these years, I haven't seen that hasn't got, and I went back and looked, that hasn't gotten a signal in 3 years. So the last signal to buy it was, I think, after late 2020 into 2021 at some point, and it moved, and that was nice. But really, you're going to see those things happen in this type of a market. And I think even more to your point of what you're saying is moving into that shipping area is probably really going to be valuable. So we're gonna end it there. I got to get going. I hope everybody had a good holiday week. This is my puppy. It escaped. We have a downstairs gate, so it just has a hole downstairs. But it came up to say hi. So this is my puppy. She's cool.
Your cat usually comes and sits on top of your chair.
Yeah, no
Right.
cat today. Just that's probably because the dogs are up here. So that's why we keep them separated. The downstairs for the dogs, the upstairs for the cats. But yeah, today it happened. So, all right, guys. Well, thanks so much for joining us. We'll be with you on Monday. Monday is the commodity report. And then next Friday at 11 a.m., between 11 and 11:15 Eastern time, we'll be with you with the macro show, or the Holy Macro. Jesus Christ, I keep saying the macro show. What's wrong with me? And then make sure to follow Kashop, and make sure to follow myself on Twitter, on YouTube at AAO Research. All right, guys. You guys have a good one.
Have a great weekend, guys.